Welcome back to the Brent Bruce Daily, where each day we take a look and see where home loan interest rates really are, what is making the move, and what to expect for the future. Today is May the 18th, 2023. It is now 3:42 p.m. Central Time. We have just about 20 minutes left in the trading day for the mortgage-backed securities and for bonds. In general, the bond market and the mortgage-backed security market are paying close attention to what is going on with the debt ceiling discussion. The whole economy is. They're paying close attention to that because the movements that are made with the debt ceiling will affect the broader economy, which of course then affects the bond market and mortgage-backed securities because mortgage-backed securities are a bond product. Now, there's something else that you need to understand when it comes to mortgage-backed securities and home loan interest rates being attached to the bond market. And that goes back to what we're now experiencing with the issue in the banking world, so the banking system. What's happening with a lot of banks, you heard about Silicon Valley Bank, Signature Bank, there's a lot of things going on with some of these larger players, and it's because of the rapid increase in the federal funds rate. So in order to resolve the problems that we're having with inflation, we had to make a dramatic move, or the Fed made a dramatic move with the federal funds rate, but that throws things off when it comes to interest rates for all products. So now we're finding that people are seeing that there may be better opportunities for higher rates of interest in different products than what they were previously using. So people are pulling their assets out of where money was sitting previously and moving it into other assets. Now, when banks lose deposits, which is what we're seeing, when people pull large amounts out from banks, that reduces their deposit base and they end up in many cases needing to sell other assets in order to shore up their books. So when you're selling assets as a bank, what are you selling? Well, one of the major products that they're selling is bonds and mortgage-backed securities. When more mortgage-backed securities are being sold by these institutional and large investors, it puts more inventory in the mortgage-backed security market. More inventory, not more buyers, makes the interest rates go up. So it's a supply and demand issue again. And we're seeing a little bit of that on home loan interest rates because even though we know that inflation is coming down, all reports are leading towards inflation is coming down, especially more on the year over year readings. We're not seeing much movement recently with home loan interest rates because of the other factors that are going on in the economy. Right now, we are down 25 basis points on the day. Again, I'm going to point directly or more so towards the discussions about the debt ceiling, but also on the backside, knowing that bonds are experiencing a little bit greater inventory than they normally would because of the effects of what's going on in the banking industry. The 10-year treasury is up 8 basis points. Again, now we're at 365, not really where we want to be. And I'll show you a little bit about why that is the case. Here is our mortgage-backed security. You can see that we've really bounced around a lot here. Actually, I'm sorry. This is the 10-year treasury report. And so, or chart here. So this is showing what I was talking about. The 10-year treasury has been banging up against this Fibonacci level as it's been trying to go up. And remember, we want this to go down. We do not want the 10-year treasury to go up because that is the yield, which basically means that is the interest rate. So if we see it going up, banging off of a ceiling of resistance, banging off of a ceiling of resistance, and now here we are breaking through that ceiling of resistance because of the discussions about the debt ceiling, as well as seeing more inventory coming about in the bond market. So this is not a good sign for where we are right now. Taking a look over here at the mortgage-backed securities, again, we're down 25 basis points. And let's see, let's let this populate here. We'll take a quick look, and then we'll see how home loan interest rates are responding. Now, look, we've been up in this range here, celebrating some wins, days over the 200-day moving average, and now we are down below we're down below every one of the moving averages that we take a look at and follow. We're down below this Fibonacci level, banged off of this Fibonacci level here, and came back up. So this is now a tremendously necessary floor of support under us, just like we saw that ceiling of resistance for the 10-year treasury. Now, once again, the 10-year treasury, this is a yield. So this is the yield. So we want this to go down. In the home loan interest rate world, we want this to go down. And this is the cost for the mortgage-backed security. We want this to go up. Okay, we don't want to see red. We don't want to see it go down. So how are we looking as far as our interest rates today? Well, let's take a look at our scenario that we watch every day, the Brent Bruce Daily 30-year fixed conventional Very well qualified, 800 FICO score, 25% down customer. Okay. So we are now looking at 6.75% with a very small credit of only $220. The loan store is leading the pack right now. Once again, you cannot go get these home loan interest rates. You have to get them from a broker like myself. These are broker rates. So let's take a look over here. United Wholesale, we always like to take a look at them. 6.75 is costing $1,000. And what is it going to cost to get to about 6.0 or 5.999? We are sitting at a cost of 1.516 to get to 6.0. I think that was about 1.1 yesterday, if I remember. And let's take a look at where we are on United Wholesale, the largest wholesale lender in the United States. And 5.999 is costing 1.726. Again, I think that's up about 40 basis points from where it was yesterday. Let's take a quick look at the scenario that we're taking a look at for compliance purposes. There you go. All right. So as you see, there's so many things that go into the movement of home loan interest rates and mortgage-backed securities, whether it's the broader economy, whether it's geopolitical issues, whether it's the debt ceiling, whether it's having interest rates going up from the Fed causing sell-offs in the banking system and then putting inventory on the bond market. There's a lot that goes into this, but it still comes back around to inflation. It still comes back around to inflation, and we see inflation is coming down. We see a lot of reason to believe and still be confident that home loan interest rates are going to come down very soon. But there are always those outside factors that we can't even think of. Like, for instance, what if all of a sudden the United States government decides to, for some reason, issue another, $2 trillion in some sort of stimulus or put it out into the economy in one way or the other? Well, that is tremendously inflationary, and that would really shoot a hole in our plans. So right now, we're still feeling confident that home loan interest rates will come down in the near future. Make sure that you like, subscribe, share, and click the notifications button up in the top so that you're notified right away when these reports come out. I try to get back with you every day if I can. We'll talk to you again tomorrow. Have a great day.